Now, so this is our second go-around, if you will, with QT in the U.S., and the first one was not particularly large. I think there are lots of unresolved questions about how it will go. From the mindset of the Fed, their idea is we got to get the balance sheet down, and in particular, they want that reverse repo facility where they have a bunch of money market mutual funds parking cash with them. They want that to be the part that runs down a lot, and they're making progress. That component on their balance sheet really has been falling. It's got under $1 trillion. So if you take roughly the rate where we are now, and then you extrapolate into the future, and you think a little bit about how the Fed likes to slow things down before they think they're done, we're looking at Q3 around the time where they start to taper QT. For the markets, on the other hand, I think there's still a really open question. Lots of folks in equity markets are still talking about the liquidity effect, i.e. the size of the balance sheet all by itself affecting equity prices. Right or wrong, if that's what the market thinks, you'll start to get some reactions there, and we've seen it from time to time. In the rates market, I think a lot of people who are looking at where the supply of, say, treasuries in particular coming to the market as the Fed shrinks its balance sheet, they took a bit of solace from the last refunding announcement at the Treasury, where the Treasury said the supply is not going to be jammed at the long end of the curve. And remember, that's how, when the Fed shrinks its balance sheet, the Treasuries go back to the market through Treasury issuance. And so that shift by the Treasury, I think, was really significant.
Seth, when you consider the long and variable impact of tighter policy, is the labour market, and by association the consumer, at something of a tipping point?
One key point I try to make to clients is we have to look at cycles, we have to learn from past cycles, but then we have to ask, what is different about this cycle from past cycles? The labor market is very, very different this cycle from past cycles. We know that the economy went into COVID, the economy collapsed, employment collapsed, the economy bounced back and employment bounced back, but nowhere near proportionally. And up until right about now, the labor market, the employers have been playing catch up.
Yes.
And so that's one of the reasons why we thought we're not going to have a recession. We're not going to see a wave of layoffs if businesses are still shorthanded. Now we're back roughly to normal staffing levels. However, businesses lived through 2 years of really not being able to hire people. When we talk to our corporate clients, there's a very strong sense of labor hoarding. We don't want to give up our workers if we don't categorically absolutely have to. So we think the economy can slow without there being a tipping point. We can slow without going off of a cliff.
Very interesting perspective.